So, welcome to 2017. Going into this year, we're seeing a meaningful change in the framework for bond and equity investors. In the Q4 of last year, we saw a shift in monetary policy towards fiscal policy, and that combined with an annualizing of commodity price falls means that we see a higher likelihood of inflation coming through in 2017. Couple that with, particularly in the US, the unemployment rate being at that low level of 4.6%, where the Fed won't want that employment rate to go much lower without seeing quite material wage inflation. We'll be continuing to monitor whether we'll get increased participation in the workforce or productivity improvements to allow that economy to move forward without greater inflation. The baseline is that inflation is probably more likely in 2017 than it was in 2016, and that's a meaningful shift. So we would urge you to look at your portfolios in that context in terms of what your sector and geography exposure is. In this week's podcast, we'll have Mark talking about the likelihood of more inflation in 2017, and Andrew linking that inflationary impulse into the real world through the next statement that we heard earlier this week. Looking at the week ahead, on Thursday is the first key day for numbers for our stocks. We've got Marks & Spencer's and Tesco's reporting. And Friday, we've got the start of the US bank reporting season with JP Morgan, Bank of America and Wells Fargo being the main banks there. The banks have been a key way of playing this move towards a more inflationary, higher interest rate environment. And as you can see, they've performed very well since the election results in the US. On a longer term basis, there's still some quite significant underperformance there, and we would still feel fairly positive about the sector because it's come off extremely low multiples and trough earnings, because we do see earnings growth coming through because of higher interest rate margins, because of a steeper yield curve, because of more activity in terms of trading volumes, because of more market share as European banking competitors feel more constrained from regulatory impacts of capital constraint, and finally the regulation repeals that are coming through in the US. So continue to like that sector. That's it from me. Thanks for listening.
For a number of years, many of the world's developed economies have experienced low inflation or in some cases deflation. However, as we begin 2017, that dynamic is beginning to change, and a number of these countries are now faced with the prospect of rising inflation. We'll start by looking at the UK, where last year's broad fall in the value of sterling has led to a ramp up in inflation expectations over the last 6 months. The falling sterling makes imported goods and services to the UK more expensive, and input prices at UK manufacturing firms are currently well above historical averages. In addition to this, the fall in the oil prices that occurred between 2014 and the beginning of 2016 have now largely fallen out of year-on-year inflation comparisons, while last year's rally in the oil price will begin to show up in inflation data in the coming months. The exact path of UK inflation depends on the speed and the extent to which these UK companies pass on the rising costs to the UK consumer. But it's not just in the UK. In the US, a number of Donald Trump's proposed policies, including increased fiscal spending and protectionist measures, can be considered to be reflationary, while in the Eurozone, CPI data released this week was at its highest level since September 2013. Also, the recent weakness in the euro may add to inflationary pressures going forward. This all has meaningful implications not just in the bond markets, where long-dated government bonds have underperformed recently, but also in certain sectors of the equity market that have performed well as bond yields have declined, but which may not do as well going forward.
Inflation was also a key theme for high street retailer Next this week, who lowered full-year profit guidance, driven by higher input costs as well as the inflation impact on consumer incomes. In addition, Christmas trading performance was slightly weaker than expected, with colder weather keeping many people away from the high street. Estimates were that the UK footfall on January 1st was down as much as 20% on the high street. Online retailers will continue to be beneficiaries of the high street disruption, with Amazon being one of our top picks due to its unmatched scale, logistics and customer service. In addition, its Prime membership service, which offers free postage as well as music, movies and TV streaming, continues to grow strongly, with membership expected to be as much as 70 million members, or roughly 20% of its total membership base.